Good evening, everyone, and welcome. My name is Chuck Roberts. I'm the Executive Vice President of the Advisory Board for the Metro New York chapter of the National Black MBAs. And once again, welcome. I know I say the same thing every time about this is one of my most exciting programs, but I'll say it again right now, just get it off my chest. I'm looking forward to hearing what these ladies are going to give us tonight on the topic of impact of inflation on the market and the economy. This is one of the follow-up sessions of rewriting your future with financial planning, which we began in November of 2019, believe it or not, with NASDAQ, with their support to get this thing off the ground. And it continues to roll. There's so much to be imparted to the community that we work with. And we want to make sure that our community is up on what's happening in their lives, not just from the standpoint of employment, which we spend a lot of time doing that, and the health and wellness, which we spend a lot of time doing that, but surely in the area of financial literacy. This is so important for our growth. And if we're ever going to do anything with this economic gap or wealth gap that we talk about, seems like once every year, if we're ever going to do anything in that area, we have to have education and awareness. So, without me saying too many things, I'm going to, first of all, just thank the sponsors, the people that make us whole here, and that's the MBA Chic and the Greater New York Black Nurses Association, of course, NASDAQ, Mass Financial Management, hope I got that right, and of course, the Federal Reserve Bank of New York are our corporations which are involved tonight. And a special thanks goes out to Marvin Vasquez and his team at MMUSA. Without them, we wouldn't have this program. So we have to be thankful for that as well. So let me also give a quick shout out to my chapter members of the National Black MBAs, both locally within the region and of course nationally. If you're tuning in tonight, welcome. Glad you're here. See you all down in Atlanta in end of September. But let me take a moment to introduce our moderator, a very special person, a friend of our chapter. She's done this a few times before for us, and she's tremendous at it. I was reading some of the comments that are written about Jill Malandrino, and they said she's the best in the business that does what she does. And I said, you know what? She is. She's very, very good at what she does. I follow her. I get her podcast every now and then off the trade talks, and I enjoy them. As I just admitted a couple minutes ago, most times I don't know what they're talking about because they're always talking above my head. But then again, that's just me. I'm not that smart anyway. I'm just, executive vice president. What do I know? But Jill Malandrino is our moderator for this evening. She'll get you through this next hour and so. She is the global markets reporter with NASDAQ. And as I said, she runs this podcast called Trade Talks, which I'm asked her to say a few minutes about that. And that's it, gang. Without any further ado, let me introduce Jill Malandrino. And thank you, Jill, for joining us again tonight.
All right, Chuck, it's a pleasure to be here, and thank you to you and Marvin. It's been wonderful working with you since 2019, and especially through the pandemic when we have all had the time and the focus to think about financial literacy and our finances, our investing, our debt management, and so forth. And it is so critical for all the communities that we serve. And again, I'm honored to be here to help facilitate that. As Chuck had mentioned, I'm the host and creator of NASDAQ Trade Talks, which, by the way, we are running our 5-year anniversary campaign. We started off as an 8-hour contract labor of love supporting our options business, and we have blossomed into a global product that supports all of our global businesses, focusing on global capital markets, digital assets, of course, personal finance and financial literacy, business, ESG is a big topic that we cover. And through the course of my work at NASDAQ, I formally co-led our Veterans at NASDAQ program. I'm now on the advisory committees. We have turned the baton over. So not only is financial literacy something that I am passionate about for my profession, but also personally as well. I'm in grad school right now with the hopes of being able to parlay that into teaching and really continue evangelizing financial literacy, because without that, we can't break out of the molds that we're in and truly advance as a society. I think financial literacy is the core of everything that we do, and everybody deserves a chance for accessibility to that and the associated technologies. So these are always one of my favorite events to participate in and be able to spread that word. And I'm incredibly proud to introduce our panel members. We have Heather Daly, she's Director of Economic Education with Community Development Education and the Communications and Outreach Group at the Federal Reserve Bank of New York. We also have a veteran panelist of ours, Christina Massale. She's a managing member with Mass Financial Management. Christina and I have served on a number of panels together, so it's great to be reconnected. And the focus of this particular webinar is going to be on the impact of inflation on the market and economy. And these are the kinds of conversations that we have to have, because while it sounds very high level and it's part of the market machinations, it really does impact us day to day with the decisions that we make around financial literacy, whether it's savings, debt management, investing, thinking about home purchases. It really does come down to that critical personal level. So I'm excited to share that with everyone tonight. And Heather and Christina, I'd like for you to both introduce yourselves first. Heather, starting with you, and then we'll get into our questions that we have for tonight.
Absolutely. Thanks so much, Jill. And thanks again to National Black MBA Association for having me here and inviting us to speak. So yeah, just to talk a little bit about what I do. So Jill mentioned I'm the Director of Economic Education at the New York Fed. And that means essentially we're running education programs to help people better understand economic literacy in addition to sort of financial literacy. So understand the economy, understand the forces at play, and also have an understanding of the role of the Federal Reserve System and a lot of the work that we do in order to promote the conditions for a healthy economy. So really excited to speak with you all tonight and hear your questions.
Thank you, Heather. And Christina,
Awesome.
reintroduce us.
Awesome. Thank you so much, Hella. Hella, nice background. My name is Christina Massale. So historically, I have 15 plus years in the financial services industry, and I've worked at Credit Suisse, Fortress Investment Group, and PricewaterhouseCoopers. And because I'm passionate about financial literacy like Jill, I founded Mass Financial Management, which helps religious organizations, individuals, and families to first identify their unique relationships with money in order to reconstruct their money and manage and build their finances. And so I'm happy and honored to be a part of this esteemed panel today.
All right, Christina, great to see you again. And Heather, I'd like to start off with you. You had mentioned before the Fed's role as we think about the macro environment, but let's start at a higher level. Explain to us what interest rates are and how do they relate to this word we keep hearing about, inflation?
Sure, absolutely. So interest rates, when I talk with students, I like to think of interest rates as the price of money. So if you think about an interest rate that some of you may have been exposed to before, say like through student loans, right? An interest rate is a percentage of the amount that you're borrowing, that you're paying in order to have access to those funds, right? Sort of from the lender as a borrower. So that's one type of interest rate, right? You're sort of paying a price for that money that you're borrowing. Now you also can earn interest. So sometimes that price is paid to you if you're a saver, because you're making those funds available for a financial institution like a bank or some other lender to make available to borrowers. So high level, sort of that's what an interest rate is. Now, how do interest rates relate to inflation? Well, when you think about interest rates as the price of money, that price influences market behavior. So when the price of money goes down, people are more willing to borrow, right? You have sort of consumption going up, investment activity by consumers, by households, by businesses will often go up because they're able to have access to more money. Now, when those interest rates or that price increases, then that economic activity will tend to slow down because, again, higher price, we're not necessarily going to go out and borrow as much money when that rate changes, when that price of money changes. So as that economic activity is happening, right, this will also impact inflation, which is sort of the overall prices within the economy. And interest rates can then be a lever. So if you see those prices increasing, too much, maybe beyond a target rate that you'd like for inflation, then you would think, all right, let's slow this down, right? That's sometimes if that rate is too high, it's a sign of what we call sort of overheating. And so you raise the interest rates as a lever to sort of cool economic activity, maybe decrease some of that borrowing, some of that spending, some of that lending and spending, and bring inflation more in line with where you'd like it to be. Conversely, right, if you don't see enough economic activity, then you're going to lower interest rates in order to increase that activity, that lending and spending.
And Christina, I keep hearing on the news about inflation rates and prices at the pump. And how does interest rates and inflation impact the average consumer?
Yeah, that's a good question, Jill. So I would say for the average consumer and for everyone, it will impact you in every way, right, in your everyday living. And so you mentioned a good example about at the pump. I rented a car this past weekend. I don't own a car. And it should have cost me $10 worth of gas to fill up the tank. It was a rental car. I didn't drive too much. And instead it cost me $19, right? And because of the price of gas. And so Heather mentioned about interest rates and inflation, right? Inflation, when you look at that, that's the general increases in prices of goods and services, right? So when you think about it in a simple way, your paycheck is going to buy you less. So it impacts the average consumer in every way. And so I buy certain things from Whole Foods, I buy certain things from Trader Joe's, and then I buy certain things from my local supermarket. Meat prices were up about 14.8% in March from a year ago, right? That's crazy. I saw somewhere that breakfast cereals, I don't eat breakfast cereals, but a lot of children do, some adults as well, climbed almost 10% in the past year. And some parents were trying to swap out more so generic brands for their family members. Kids were not having that. And so they've heard resistance from their children. Oh, we need to go back to the name brand cereals and things of that nature. So airline costs, we see airline costs have increased. We see rent has increased. Your daycare for children or day camp, everything has increased. And so inflation is definitely going to impact you. And then when you think about the way the rates are increasing and will expect to continue to increase throughout the rest of the year as signaled by the Federal Reserve, Heather already mentioned, this is the rate at which it's the cost of capital. This is what we borrow money at, right? And so a couple, years ago, mortgage rates, which are still historically low, they were even lower than they are. So some of my friends were getting, for their new homes, they were paying 2 and change percentage-wise for a 30-year mortgage. Right now, mortgage rates for 30-year mortgages are above 5%, right? So this is just to show you the impact of interest rate increases. Auto loans, if you're looking to get a new auto loan, the rates are above 4%, right? So what does this mean? It means that, as Heather already indicated, you have low rates generally to stimulate the economy, like we saw during the pandemic where rates were virtually zero to stimulate the economy. When rates are higher, we're looking to cool things down. And so everyone at this point, it affects the average consumer in every single way.
It's interesting that you made the analogy with gas prices. I remember in the beginning of March, and I drive a tiny little SUV, I think it's maybe 14, 15 gallons. It used to be like 40, 45 bucks to fill up. And, because I don't commute every day into the city like we used to prior to COVID, I wasn't as conscious of it as I might have been before. And I filled up and it was like $70. And that is a huge disparity. And to your point, Christina, with mortgage rates, to see them go from 2.5 to 2.75 to over 5% in less than a year, the velocity of that move when you're thinking about interest rates is pretty significant. So Heather, my question to you is, why are we hearing so much about interest rates and inflation now? Is there historical context we can put behind it to understand why it feels very dramatic?
Yeah, absolutely. And I got so excited to jump in. I forgot to mention that opinions I share are my own, not necessarily those of the Federal Reserve System or the New York Fed. And the reason we say that is, what I say tonight, I don't necessarily want to impact your investment decisions. Whereas what Christina says tonight probably should impact your investment decisions. So keep that in mind. But so this is important, this context, because sort of what you talk about these rates, you talk about inflation, and there are sort of targets, right, that we're typically trying to achieve with something like inflation, right? Generally speaking, economists think a little bit of inflation is a good thing because it allows you to have sort of conditions to avoid deflation, which is really a problem that we find a little bit trickier to sort of try to manage out of. But have some activity, enough economic activity that you're still sort of seeing growth, right? You're still seeing that investment in businesses and homes and things that people want to purchase. And so the Fed overall is targeting a 2% average inflation rate over time. And that's a particular measure. I can get into the details on that, but it might be too much. But it's a particular measure of inflation called personal consumption expenditures. And we want that to average 2% over time. For many years, for basically a decade, right, we weren't hitting that target. There, it was essentially slow recovery from the financial crisis, taking some time after, even though interest rates then were held at zero for much longer than in sort of the response to the pandemic. And so there was sort of this feeling for a long time frankly, up until say 2019, 2020 of sort of like, where has inflation gone? Now, more recently, though, we're seeing these rates well above the target rate, sort of above where the Federal Reserve System sort of thinks is sustainable and healthy, and to keep prices stable is one of the jobs that Congress has tasked us with. So today, if you're looking at CPI, the latest consumer price index measures are at about 8.5%. So that's 8.5% increase overall in prices from a year ago. And that's sort of all in. Then when you think about the things that Christina was talking about, like cereal and gas and fuel, right? There's another measure that looks only at what they call core. So it excludes those things like food and fuel in order to sort of forecast longer term trends. However, in the day-to-day, right, we recognize that people buy gas, people buy food. So you do need to look at what they call those headline measures as well. So for consumer price index, it's 8.5%. For the personal consumption expenditures index right now, it's at about 6.4%. No matter which measure you look at, right, it's above that 2% average that we'd like to have. So this is in the news, right? People, even if you don't read the news, you can feel it, right? You can feel it at the pump, you can feel it at the grocery store, that those prices are higher. So in response to this, right, that lever is likely going to move. And it has moved. So when I say that lever, that interest rate lever, we saw this inflation happening. It was a little unclear for some time as to, is this temporary supply chain issues, or is this something that's going to persist? It's persisted enough that the Federal Reserve, the Federal Open Market Committee voted to raise rates in March. And we'll see what they do in May. There's a lot of forward guidance and talk that looks like, another increase, and to what extent, we don't know, but until they announce it. But you're seeing basically then this path on, okay, the brakes coming on, right? All the brakes were removed with the pandemic because we didn't want to constrain a recovery as much as possible. But now what you're seeing in the face of these price increases and inflation is, okay, the party's going to slow down, right? Going to slow down that progress to try to bring it back in line, the inflation rate, the price level, at that average 2% target.
Christina, through the course of the webinars that you and I have done together, we always talk about financial literacy on a higher level, and not just investing, but really how to manage the personal home balance sheet. And we know that our wages aren't stretching quite as far with rising rates and inflation. So how are you recommending to prioritize savings versus expenditures, debt, even refining and home purchasing? Where do you prioritize where the income sheet is going?
Yeah, so let's kind of like take all of those individually. So one thing for sure is people should continue saving. And when I say saving, meaning investing, right? Because investing will be your hedge against inflation, right? Particularly since as Jill already mentioned, wages are not increasing or aligning with the rate of inflation. So now during the Great Resignation, we've seen a lot of people moving to jobs and they're getting these big bumps. But this is something that's kind of like a one-timer thing, right? It's not projected to continue to be perpetual, right? And so I would say savings should continue, but this is where you have to be more strategic with it, right? So there's still investing in your 401k, right? And still maybe doing like something like a core satellite approach, which we call in the financial planning realm, where for some of your core investing, you put it in maybe an index fund, and then your satellite approach for specific things, you're starting to invest in certain single name securities that and we can get into discussions later more on portfolio. But I do want to encourage people that this is not the time just because, we see maybe the market is going down because of the inflation and we see this, that you stop investing. In terms of expenditures, I would say it's really a good time it's always a good time. So don't think there's never a good time, but it's especially a good time when prices are going up to really take a look and see what you don't need. So there's times lately I've been going to the supermarket. I'm like, do I really need to eat that right now? No, I don't need to have that. It's just really insane. And maybe the byproduct is I lose a few pounds that I gained during the pandemic. It's all good. I know I'm being extra, but really examine your expenditures to really get a look and see and look to purchase things that are on sale. Because sometimes I look and I say, okay, I'm going to the supermarket with my list and I'm sticking with my list. I'm not going to get distracted in this right now and just come out with all these things. Because as everyone knows, you go into the supermarket for 5 things, you leave out, you spend $80 and you're like, what happened? This is inflation in real terms, right? And everyone's complained about it. In terms of debt, right? So this is also another thing. There's some people that they don't really understand the terms of the debt that they have actually signed up for, and whether they have like some kind of teaser rate or an adjusting rate versus a fixed rate, right? And if you do have some of those terms where your rate actually adjusts, this is a time where your expenses can drastically increase, particularly in a year where the Fed is expected to, like Heather said, we don't have the exact numbers and no one can release that information, but there has been some rumors and things and discussions that the rates will raise several times this year, right? We don't know by how much exactly. So if your debt the cost that you finance your debt at is going to adjust, your expenses on your income statement is actually going to increase drastically, right? And so that means that you need to look at your overall expenses to see where you can reduce in other areas potentially. Or on the other side of the coin, from an income perspective, how can I look to bring in additional income to offset these expenses, right? Refinancing, I think you mentioned, Jill, not the time, unless your rate, unless by some chance you did not refinance during those times, the past couple of years, when the markets were favorable, interest rates were very favorable, when rates were down to 2.5, 2.75, even low 3s. But now that rates are above 5%, you do not want to refinance and get a rate it doesn't make sense, a rate that's higher than your existing rate. And then there's also a cost to refinancing, right? So get someone to help you to do the analysis to see the cost benefit of that. But yeah, so prioritizing, I would say you still definitely need to save. You need to focus and look at your expenditures. This may be a good time. Like I said, a lot of people have side hustles and they're actually making some money off of their side hustle. So maybe to absorb some of those expenses because of inflation, you can look to lease out your skills, right? Because we all have talents and gifts that we're naturally endowed with. And maybe it's time for us to lease some of those things out and gain some income.
You just gave me a great idea, Christina. We have to hook up with Chuck and do a webinar on the creator economy and the economy, because there are so many things
Yes.
that you need to know in terms of running your business as a creator, and also as a gig employee. But Heather, I want to go back to the Fed for a moment. You explained its role on a high level with adjusting interest rates to tamper inflation, but let's really drill down. What is the Fed? Why do we keep hearing about the Fed? What is it, and really what is its role when we think about the macro economy, not even just with the US, but globally? The Fed has an impact.
Yeah, so I mean, I'm going to get a little academic for just a tiny bit. So the Fed or the Federal Reserve System is the central bank of the United States, right? So that's the very highest level. We're a bank for banks. We're a bank of the United States government. And essentially what that means is the primary policy area for which the Federal Reserve System has responsibility is monetary policy. So really influencing the cost and availability of money and credit. And so that's where interest rates come in, right? That's that cost in order to make money and credit either more or less available as sort of warranted. Now, the very high level mission of the Fed, as we sort of wisely shortcut ourselves from having to say the Federal Reserve System every time, is really to ensure that the financial system is stable and to promote the conditions for a healthy economy. What exactly does that mean? Well, the interpretation of that mission has evolved over time, right? The Federal Reserve System has been in place since 1913, and the way that its responsibilities have been interpreted have changed over time, established by Congress. So its goals, its responsibilities are set by Congress and mandated by Congress. But when we think about monetary policy today, Congress actually reformed the Federal Reserve Act, which established the Federal Reserve System in 1977. And these goals have endured to today, to say that the Fed has a mandate to do, well, really three things, but for whatever reason, we always focus on the first two, and that's to maintain stable prices and maximize employment. Now, and that's where those interest rates come in, right? So the Federal Reserve System has an element called the Federal Open Market Committee, which involves different aspects of the parts of the Federal Reserve System to decide what happens with interest rates. So essentially every 6 weeks, 8 times a year, that committee meets to assess the market conditions, to assess the economy, look at all of the data and all of the indicators, a lot of which, you know, we were talking about earlier, to say, okay, should interest rates remain the same? Should we raise them or should we lower them? And they're using a target rate, the federal funds rate, and also other administrative rates in order to sort of set that temperature for the economy. And then the rate decisions that are made percolate throughout, right? So you'll have, for example, right now, the target federal funds rate is a quarter percent to 0.5%, so 0.25 to 0.5%. Well, obviously that's far and away from the 5% rates that we were talking about that Christina was referencing, but that's because that's sort of a floor, right? And then different market rates throughout the economy get set above those target rates. And then influencing the direction. So influencing the availability of money and credit in the United States, and then potentially also impacting global markets. So as those interest rates go up, right, there are winners and there are losers in every scenario, right? Interest rates go up, who wins? Well, savers win, right? So they can earn more on money that they save. Bondholders could win, right? Generally speaking, there's concern that the stock market could be affected. Why is that? Well, when you have bonds that are sort of considered traditionally safer assets, providing a better return, investors are going to sort of head that way versus the stock market, trying to pursue higher returns in stock markets. Globally, sometimes this can have impact on emerging markets in similar ways, right? If US bonds are potentially paying higher yields, that's considered a very safe investment, a very safe place for investors to sort of put funds. And so that money may flow back to the United States as interest rates rise versus, say, emerging markets. Now, that's kind of generally speaking, not always, but that's some of the impact that monetary policy decisions in the United States can have sort of far beyond our borders. And then impacting sort of the price of debt, right? It certainly impacts the price of consumer debt, but also national debt. So if you have countries that are sort of basically borrowing to finance their economic activities, economic growth, or recovery from the pandemic, then the interest that they pay sort of on their debt as well can be impacted if interest rates go up.
And Heather, I have a follow-up for you, but I just want to remind everyone in the audience, if you have questions for us that you'd like us to follow up on, please put them in the Q&A section at the bottom of the Zoom screen so we can make sure to get those to you. But Heather, I have a question. It almost seems like, why not keep interest rates lower? It sounds like it might be better for the global economy. Does it make sense to keep them lower longer?
So, in the right scenario, right, low interest rates seem like a no-brainer because you're making it easier for people to borrow money. You're making it easier for people potentially to buy homes or start businesses and really sort of incentivize this economic activity. And, the downside to that is inflation. I mean, the downside to that are some of the price impacts that we're seeing now. So if you're at a point where essentially something with the supply and demand has gotten out of whack, right? If your prices are much higher than, say, wages are keeping up. And so, if you have inflation that persists for that long, what happens to the value of your money, right? The value of your money, as Christina said, is going to fall. Well, one of the things that we want to do is make sure that not only you trust your money, but that you're able to trust its value, that you're able to plan ahead. Inflation that reaches really much higher rates, right? You're very much unable to plan for the future. How much is it going to cost, to run my business next year? How much is it going to cost for me to buy my materials, to hire the workers that I need? How much is it going to cost to save for a house or something like that? If that rate is too variable, that rate of inflation or too high, households and businesses can't plan ahead. And that then impacts economic behavior. And it may actually spur you to buy more things now and keep increasing that activity, keep heating up the economy. Or if you're trying to fight to pay workers more now, right, that also has an impact to sort of increasing the amount of money circulating in the economy. So, there is that downside to sort of low for too long. And so when you start to see inflation persisting above target levels, that's when the Federal Reserve starts to say, okay, maybe now is the time. So the goal is to bring that inflation down. But again, sort of hopefully in a way that you're still keeping the pot on the stove simmering, that you're still keeping economic growth, but that pot isn't boiling over.
And just real quick, Jill, if I can add on to what Heather was saying, what she described is actually what's going on in Argentina right now. So people have actually been buying things because this week, the prices are going to be lower than what they will be next week. And their inflation is up to like 50%. It's insane. So even though our inflation is high, hey, it could always be worse.
Yeah, and that's actually kind of the typical threshold for hyperinflation, right? It's 50% or more. And so if you're at a point where prices are changing daily, right? That's the amount of uncertainty that injects. And then you get to the point, that's a point where you really can't predict what the value of your money is going to be from day to day. And we're not near there, but that would be exactly the situation to avoid.
Right. It sounds like it's a very delicate balancing act that the Fed has been tasked with to align supply and demand. And Christina, I want to get into investments with you in just a minute, but Heather, we had a great question come in with our Q&A, which I often wonder myself. When do you anticipate inflation will either top out or normalize?
Boy, if I knew the answer to that question, I'll tell you, I would have the chair's job. No, I don't know that I could say like exactly where it will top out. I mean, I will say that, and I know we're going to talk a bit about sort of some of the macroeconomic conditions happening not only in the U.S. but around the world that are impacting prices. So it's not just I would argue, at least in my opinion, not just an issue of rates being low for too long, right? But there are these other sort of macroeconomic conditions happening that are also pushing prices higher on the supply side. So things like supply chain issues, right? If I can't get the materials that I need, if it's slowing things down, if I'm not able to get the workers that I need, the employment market right now is very tight. So I really think that the answer to that, frankly, is going to be when we see some of those issues resolving themselves. And I think we're starting to see some of that. On the employment side, you still have a very hot labor market, but the labor force participation rate sort of eking up, I think, is actually really positive because it tells you there aren't too many workers sitting on the sidelines who are waiting for more opportunities. I should say prime age. I'm talking about prime age participation rate, getting back a little bit closer to where it was before the pandemic. There was just a concern that, are these workers going to come back? So with labor, with supply chain, with some of the sort of geopolitical issues happening right now, I think until some of these things resolve themselves, it will be very challenging to see exactly when is going to be the stopping point for inflation. Interest rates will do what they can, but there are limits to monetary policy as well.
And Christina, I want to come back to investor portfolios for a moment because we're talking about the value of the dollar and how far it will stretch. What about, we're living longer, we're retiring a little bit later, but we are living longer, and we need to think about where fixed income and the dollar will take us. What's the impact of high interest rates and inflation to investor portfolios?
Yeah, so that's another good question. I mean, regardless of if we're in a market where there's very high inflation or rates are going up, I think it's important that we should always look at the real return on our investments, right? And so this is something that's very key. So someone may say, well, okay, well, Christina, what is that? So let's say, for instance, I know Heather mentioned the inflation rate is the core inflation rate, at least because she mentioned two different ones so eloquently. It's 8.5%, right? But let's say your portfolio for the year earned 10%. Your real return is 1.5%, right? So because you take the difference between the two, the return that you generate on the portfolio less what the inflation rate was, right? So when Jill just mentioned is, okay, how does all of this impact your portfolio? And it's particularly as people are living longer, which means that you may want to retire at 62, early retirement, AKA, or 67 or later, 70, and get the extra Social Security boost, just throwing that out there. You may want to retire a little bit later, but let's say you live until 90 and you retired at 70, you still have 20 years to go, which means you needed to have a portfolio that can sustain you, right? And so generally, you have to have a portfolio where it's diversified, obviously, where it's appropriately allocated, meaning in asset classes that will give you the proper returns over time. And it's really important to obviously have your portfolio rebalance over time. So when we saw the pandemic and interest rates were virtually zero, as Heather mentioned, bonds were not really a viable investment option, right? Because the yields were not there, which means you were not going to earn money on bonds as you would in the stock market, right? So what's starting to potentially happen, what we're seeing is that stocks are starting to come down because they're looking to cool the economy off, right? And so you may potentially see people go back into bonds, particularly conservative investors who may say, okay, I want to at least have a return that will be higher than inflation. And when I say higher than inflation, at some point, we do expect to get to the target rate of inflation of the 2%, as Heather had mentioned, right? So let's say if bonds at some point are earning 4%, they're earning more than inflation. Some people, that's an investment that they can tolerate, that they can stomach. In terms of the bond, you loan money, right, to a company, you loan money to a municipality, and now you're getting payments back in the terms of fixed interest payments periodically throughout the year. And then when that bond matures, you'll get your principal payment back as well, as opposed to a stock, which potentially could be a bit more risky depending on the company. Let's just look at Peloton. I'm not telling anybody to buy Peloton or not to buy Peloton, but Peloton today, when I saw earlier, it was trading like $19, low $19. And literally in the height of the pandemic, Peloton was doing wonders, right? Because it was more of a work from home play type of stock where people were buying Pelotons. And so what does that mean? Peloton, then they have to produce more, they hired more, and all of these other things, right? But now what's happening, they're going to have to lay off employees. They're going to have to do this. They're changing their business model because of the nature of what's happening in the markets, right? And people are not necessarily buying the product as much. So with all of that, the portfolio is very dynamic, right? The economy is very dynamic. It's ever changing, which means that your portfolio has to be set up where it can take shocks to the portfolio, such as now, which means you need a good diversified strategy and a good allocation strategy, right? And so rates are going to rise, rates are going to go down, inflation's going to come, inflation's going to go away. This is all part of the normal business cycle, right? And we'll see these things over time. So it's a matter of, okay, what can you tolerate over time for your portfolio? And so I would definitely say, if you need help, definitely reach out to someone who can help you. I'm telling people it's not the time necessarily to be so emotional, because today you see that the market is tanking, right? It doesn't mean that the market over the long term will not help you to meet your goals that you have had. So I would encourage people, you set up your plan, you make adjustments will be needed as necessary, right? But it doesn't mean you're so emotional, like, oh, I'm going to go sell everything now because of XYZ happening. Jill, does that answer your question?
Yeah, it definitely does. And Christina, like I said, I remember you and I, when we first started doing these webinars together, it was April or May 2020, really in the thick of COVID initially. And if you pull up, even a 2-year chart, if you look at that blip we had in March, April, I mean, what if you got out of the market in the middle of March? Look at the returns that you might have missed. So when you think about it longer term, and I think in today's environment, our culture and our consumer habits are so obsessed with on-demand and instant gratification that we forget that there are averages, and this is why we invest longer term to ride out the machinations of the market. But Heather, I want to bring you back into the market. We have back into the conversation. We had a great question come up in our Q&A, and you had alluded to this before. We have someone asking, what about the macroeconomic and macro geopolitical issues? How does all of this influence inflation?
So this is a great question, because there are a lot of different factors to consider, right? So, for anyone who has taken their sort of intro econ, right, you think about the supply demand curves and sort of where those intersect. And anytime, they're out of whack, if you don't have the proper sort of adjustment or equilibrium in the supply demand equation, then prices can be affected, right? Because that's where it intersects. It's sort of what price are we willing and able to pay for those goods based on how much of it there is, and how many people want it, right? So what's kind of interesting, at least what we see right now, is there's a lot of impact on the supply side, right? Different pressures. So what are some of those pressures? Well, one is COVID, to a certain extent still, although I would say, again, in my opinion, not as much as at different points over the last 2 years. But with COVID, you have some lockdowns happening right now in China, different areas that are production areas, right? That sort of supply the goods that people want to buy. And so if you have an uptick in COVID and it starts a response, say like a lockdown, and workers aren't able to work, they're not able to sort of maintain the levels of production that the demand side is asking for, so the number of products that consumers would like to buy, then the price is going to go up. So that's sort of one impact. I know we talked a little bit, and I saw a mention in Q&A about Ukraine, right? So you have geopolitical unrest, and just 2 examples I'm going to use from that sort of conflict. I mean, one is Ukraine is a supplier of wheat, right? Russia is a supplier of oil. So you have not only the country that's sort of it's really countries on both sides of that conflict that can impact then the overall supply of different things in the economy. If people aren't willing to buy Russian oil, if countries aren't willing to buy Russian oil, then that's impacting the overall global supply of oil that's available, and potentially pushing those gas prices up. Wheat, right? If there's fewer bushels, I don't know. I'm not a great farmer, so I'm not sure exactly. Sheaves of wheat, right? If there are fewer bushels or sheaves of wheat on the market, but everyone's still buying bread, right? That's going to drive the price up. So if your supply and demand are misaligned for whatever reason, right? Whether it's sort of a COVID or Ukraine, or maybe shifts in buying behavior, that's another piece that it's a little less sort of geopolitical, but in terms of macroeconomic behavior, that shift during the pandemic, when we were stuck at home and people were thinking, oh, you know what, instead of going to my workout class, like Christina mentioned, I'm going to go buy my Peloton, right? So I'm going to go from paying for a service where someone was delivering an exercise class to me, to buying a product. Although, certainly Peloton has a service aspect too, right? But the actual setup there being, sort of a shift from more services to more goods. So that also could impact the supply, right? All of a sudden, there was more demand for production than even pre-pandemic capacity that was available for certain goods, because people were shifting from, okay, I'm not going out to dinner. Instead, I'm going to buy myself a whole set of cookware, right? And that impact too, although that's starting to swing back a little bit. We're seeing a swing back to the services side. But all of these things can take time to work out in potentially with something like a geopolitical situation, right? We do not know like exactly how that's going to resolve or when. And so there could be some impact there on prices for a while. So if you can't impact the supply, what's the lever that you have? It's the demand, right? And so raising those interest rates, the point of that is to bring the demand down a little bit in line with the supply levels, because prices are high. If people are still paying them and the demand stays at the same level, then you just have the potential to sort of sustain that inflation. And so you want to reduce even on the demand side of the equation a little bit by raising those interest rates. And it's a tough balance. I mean, it's not an easy problem to solve, but we know that we have solved it historically.
Yeah, and Heather, to your point, and this is something that could be very relatable for everyone that is participating tonight. Let's think about streaming services as an example. We've seen in the news lately how streaming services have been losing subscribers because there's just so much out there. How much more will consumers pay if they raise prices? How many services are they willing to pay for? And we're starting to see that demand destruction happen. So you're seeing the natural market forces help to align that supply and demand Christina, I want to ask you a question that came in through Q&A, and this is one of my favorite questions for Financial Literacy Month. How do I get started? Equities, fixed income, digital assets, where do I even start?
Yeah, that's a great one. Well, first of all, you can get started with any amount, right? You don't have to have a lot of money. So let's dispel that myth that you have to have a lot of money to get started with investing. There are so many platforms at this point in time where you can actually like stash. By the way, I'm not endorsing any ones that I mentioned. I'm just throwing out a few names here, Acorns, but I'm not endorsing anything. There's other, even Charles Schwab, Fidelity, all of these other retail brokerages, there's no commissions that you pay on trades now as well. And so there's also good tools that people can use to do some preliminary market research as well. You can even build, like a watch list to see what's going on with particular investments that you like. And so I tell people to start with companies that they buy, right? If you like Apple phones or you like Apple products, look at Apple, right? If you like Nike and you like sneakers, look at Nike and just other things, right? When I would ride the train, I would kind of see what's trending. You see what people are wearing, you see what people are doing, you see what people are in touch with. And so I would definitely encourage you to get help as well if you're looking to build. I was talking particularly you can do equities, obviously, on those platforms. You can do fixed income in terms of bonds. You can open a margin account, get the expertise for the margin account. Don't say Christina told me to open a margin account and now I'm in all of this debt. That's not what I'm saying. And so there's all kinds of things that you can, at this day and age, there are tools and so much. I just feel like right now there's so much on YouTube. There's also so much on TikTok. There's so much information that's out there, but it's about getting the right content and the right information. So things such as this panel, for instance. Okay, how can I start? You can start with buying a few shares and monitoring it if you're afraid to actually see, okay, well, how will this perform? And you start to see, okay, well, I bought this investment, now it's going down, and should I sell it? Should I hold it? And you start building up your tolerance of actually what will work for you. And if you have any questions, you can feel free to reach out to myself or several others. There's links for other webinars that have been done in the past as well with financial advisors that can help out as well.
Yeah, that's a great point that you bring up, Christina. And I actually had an interesting guest on my show today talking about knowing what you own. Sometimes what you see, whether it's Reddit or other microblog sites or social media, and we certainly saw this over the past 2 years with the COVID-19 pandemic and the influx of retail investors that come into the market. Things are not as easy as it seems, and truly understanding what you own and understanding the risk tolerance is key too. I'm sure you talk about this all the time, but don't come into a trade or an investment like, okay, how much can I make? But understanding what the risk is and knowing I can live without this capital and truly understanding the fundamentals behind what you're getting into, I think is very important.
Yeah. Yeah, no, that's a really good point, Jill, because people, it'll be interesting too to see, because we saw millions of accounts that were opened up, right, during the pandemic. And because more retail investors entered into the market. And so one of the things, like Robinhood had announced today that they have to lay off, I think, about 9% of their workforce and different things like this. And this is one of the platforms that is out there where they help people to invest their monies and things of that nature, right? And they grew too fast, and all of these there's a confluence of factors in regards to why they have to do this. But I say all of that to say, it will be interesting to see as the market goes down this year, the tolerance and the appetite that the newer investors have, right? If they're going to stay in the market or exit. As things are, in my view, the market will I expect us to continue to see some downward trends, at least until things continue to get priced in with the rate increases. China has their shutdowns, may cause inflation to persist as well, because all of these countries are connected, right? We're all interdependent on each other. And as Heather mentioned, one country, the wheat, oil, all of these different things. And we really rely on each other for the global economies, right? So if one economic powerhouse sneezes, everybody else catches the cold, right? And so it's something for us to just be mindful of and look for the overall long-term view.
Yeah, and to your point, I mean, think about it, especially over the past 10 to 15 years, we've only seen the market go from the bottom left of the chart to the top right of the chart in one direction. We have a generation of investors and advisors who have not experienced prolonged volatility like we're seeing now. And Heather, I'd like to get your thoughts on this, because Christina was talking about some of the impacts it could have to labor. I know the Fed, one of the crucial data points that you're always monitoring, of course, is labor participation rate, the employment rate, and so forth, and that impacts policy decision.
Absolutely. I mean, it's the other side of the dual mandate for the Federal Reserve, right? So you have stabilizing prices and maximizing employment. Well, there's an inherent trade-off between those two goals, and it's very hard, typically speaking, to balance both and really serve both. And so one benefit, that I was thinking about, Jill, to your question about like, why not keep rates lower longer? Well, one reason to keep rates low for longer is if you're trying to sort of positively impact the employment market, right? And we know that although people often look at one aggregate rate for unemployment, so the kind of overall U3 or official unemployment rate right now is 3.6%. But behind that number, there are differences, right? There are differences in demographics, there are differences in education level. And so depending on who you are in the economy, you may or may not be experiencing that same sort of 3.6%. And so that's been an argument in the past for sort of keeping rates lower for longer in order for the benefits of a hot economy to sort of reach more groups within those distinctions and within those different, who are having different experiences in the employment market. Now, having said that, what we're seeing right now is a very, very hot labor market. So you have that 3.6%. You also have, I know Christina referenced sort of the trends known as the Great Resignation, a lot of people sort of moving around and shifting and looking at different jobs, and also then pulling in some people who maybe were waiting a bit after the height of the pandemic, thinking either I'm a little worried about going back to work right now, or having childcare issues. And unable to go back to work because the supply of child care hasn't quite rebounded to where it was. And so you had some people sitting on the sidelines. Well, that's starting to change, but you still have right now 1.8 job openings for every person looking for a job. And that's just sort of you want to see a healthy labor market, you want to see healthy employment, you want to see opportunities for people. But at the same time, that's almost too tight to be sustainable. And there's sort of two sides of the coin to wage increases in terms of inflation. Wages, the last data I saw overall were up about 5.6%. So not quite keeping up with some of the inflation rates that we've seen, and sort of the 6.4 of headline PCE, personal consumption expenditures. But the downside of continually increasing wages is ironically increasing prices, right? So you might get a wage bump from that switch, but if it's not outpacing the rate at which prices are going up, then overall you're not necessarily seeing a change in the quality of life. And so those are other issues, right, that you're sort of grappling with. How do we balance stabilizing those prices and maximizing employment? So keeping a healthy labor market, but maybe not quite as hot as the one that we have today.
All very good points. And believe it or not, we have already chatted for an hour already. So Chuck and Marvin, if there are any additional questions that we need to address, or any other remarks you'd like to make, I will certainly turn it over to you.
First of all, I'm blown away by the discussion tonight. I have one minor advantage here is that when I was in college, I actually minored in economics. So a lot of the terms and conversation fit right into my memory bank, but it just jogged. It was like painful. I hadn't heard these things talked about in so many years. But as I heard the word eloquently used earlier, this was an eloquent presentation, guys. You guys did a tremendous job. The whole idea, once again, of education and awareness means you got to learn a lot about things you never heard about before. You got to take a risk. I didn't hear risk mentioned tonight too often, but you got to take a risk to get into things that don't feel comfortable. You have to expand your horizons. You have to know why interest rates are where they are. You have to know why you're not investing in bonds at certain times. I did see one question, but I think we did answer it. Marvin will correct me if I'm wrong. It came over Meta. I don't know if I got to log you back into my phone here. Someone was asking about the housing bubble and the rest. And I know we did cover that. And then, of course, another person was talking about the fact that products are subpar, but the price of them are continuing to go up. You know, we don't have much control about. Anybody want to comment on that? Is there any thoughts on that topic?
I mean, I think.
Go ahead, Heather.
Sorry, go ahead. No, go right ahead.
I was just going to say, unfortunately, we don't have control over the companies will determine the products, right? And I know, like, for instance, there's restaurants that I've gone to and I noticed certain ingredients are no longer there. So it looks different, it tastes different. And so the quality is just not the same, right? But I do understand at the same time that they've had to make significant adjustments, right? Because of something as supply chain disruptions, and you're not necessarily going to maybe get the same thing. So that's just with food, guys, I'm talking about. So maybe I won't go back to that restaurant. I'm like, I'll wait until they get better there. But in terms of, like, if I'm expecting, let's say earbuds to be of a certain quality and you paying the money, I would definitely write in a review to indicate that I wasn't happy with the quality, because that's feedback for the actual companies. But I do think that is definitely a concern for sure. Go ahead, Heather.
No, I mean, I was just going to say, I think that's another aspect of inflation, right? I mean, some businesses, either if they're not able to get the materials or the food or the type of ingredients that they want, right, might have to adjust the product. I think the other piece that, I've heard some talk about sort of more popularly lately is this idea of, even if the price stays the same, right, if the service is somehow reduced or the product itself is a little bit different, that's potentially another form of inflation, right? Because the price might be maintained, but maybe you're not getting the same value that you used to from that product. So I think it's a concern. I think it's a real concern. I would agree with you. Stand up for yourself and talk to people if that's a concern. But I do wonder, and this is definitely not the view of the Fed, and just the view of me as potentially an older person who didn't grow up with the internet, is I am interested to see if there's any impact to consumer expectations that lasts, right? Because there's this idea of, we order something, we want it in 2 days, and it's like this. I've had to explain to my kids, like, we would put a letter in the mail and then we had to wait 4 to 6 weeks. That was always the magic number, 4 to 6 weeks to get whatever it is. And I don't know that, I'm not advocating, I'm not a Luddite. I wouldn't say, like, we go back to that. But I think it will be sort of interesting to see, do people's expectations change? Do they adjust long term, or maybe not? And that's okay. I mean, that's an important part of the equation, to see what those longer term expectations look like and whether there's any impact to them or not.
Oh, Chuck, you're on mute.
Okay,
Can you hear me now?
Yeah, I can hear you. The question just came in. Let me read it as is. I think we may have touched upon it, but it does sound like it's a different twist on it. Given market volatility, should the strategy be to hold your current investments or seek to make your portfolio more conservative. Does it depend on your age, risk tolerance, or other factors? Apologies if this was asked earlier. That's Pastor Joseph Brown.
I would say that you kind of answered the question in the question, because it really does, it really depends on your time horizon, right? It really depends on your risk tolerance, you know, and some companies are, for instance, reducing some of their investments for companies that they may no longer believe will generate the returns that they expect to obtain, right? But they're not just dumping everything out of their portfolio, because they're taking a long-term view, and looking with a long-term view of earning returns. So one thing that I would like to say and encourage people is, like, remember that this is a point in time. So for instance, this right now we were talking about interest rates. So think about what companies are going to do well in a rising interest rate environment. Financials will expect it to probably do better, right, than some, you know, if we look at historical, and then if we look at as well as some things that we've learned, because they generate returns, a lot of them, right? They extend loans, they finance activity, and so they're going to make money when interest rates go up. So that's, some people may do more of a balanced portfolio at this point in time, and that's where we talk about rebalancing and reallocating, where you have more of a blend of equities and bonds. Maybe in the last couple of years, the allocation was higher weighted toward equities, right? Where you were getting more return from equities. But that, once again, all of that will depend on the person's age. It will depend on their time horizon, their personal goals, as well as their risk tolerance. Because some people have the capacity to take on risk, meaning that you may have the money. Like, let's say, for instance, somebody has $100 million that they want to invest, that they're able to invest, but they actually cannot stomach putting $100,000 into the market. That means that their appetite to tolerate, I'm going to use the word risk here, Chuck, because you said we weren't really using it. So they may not have the appetite to tolerate that much risk being in the market. But hopefully we answered your question, where it's a combination of all those things: your time horizon, what you're expecting to earn, as well as how aggressive you may want to be in the market, et cetera. But me personally, I take a long-term view and watch, unless there's something that I believe really that I should exit, right, and it's not in line with the strategy.
Yeah, I kind of heard the answer to this question earlier too, and I guess we have time for this, sneaking one more in here. But it sounds like the gentleman's an entrepreneur, so let's give the entrepreneurs a nod, as I'm glad they came in listening to us. But he says, any thoughts on the increase in diesel fuel prices? It is impacting the trucking industry tremendously, especially the owner operators with 1 to 5 trucks. How much longer until we see a decrease? Any thoughts on that? I know we kind of said we don't have the answer, right? But Heather, you want to throw back at that again?
I think what I could say to that is, you know, always energy is going to impact other parts of the economy, right, as well. So I think it's good to take that view, or that thought of, you know, how does this impact industry? How does this impact either my business, or how could it impact, you know, basically any area? And energy is one of those things that impacts all of us, right? I mean, so whether it's diesel fuel, whether it's oil, whether it's gas, you know, you watch those prices and those indices very closely, because that's input to the economy, and to being able to produce, to being able to provide the trucking services, even to move the goods, right? So that potentially has a relationship with supply chain issues as well. It's just, it's a great to have the goods produced, but if they're sitting in the factory and can't get on the road to the customer because it's too expensive for you to be able to do so at a competitive price, right? That's another issue, certainly, to take into account. So, you know, so I'm sorry, I don't have a great prediction for you in terms of when the price might level out, but I do think those are really important questions and considerations for sort of the economic outlook as a whole.
Right.
I just want to comment on the last question here before I turn it over to you to wrap. But we have a couple of great points came through Q&A and chat that the size of packages and the quantity of packages look very different. A lot of pasta in my house, as you can tell with the vowel at the end of my name. So a pound of pasta, which is typically 16 ounces, is now 12 ounces. That's one example. You see in ice cream, you see in snacks with the kids and everything. And the reason I bring this up is we are in the thick of what's called earnings season, and public companies report every quarter. And I encourage you, whether regardless of how ingrained in the market you are, but if you listen to consumer staple companies like a Pepsi, like a Coke, even airline companies or energy companies, right now they're talking to the investing public about that with what margins look like. So they will, less quantity or increasing prices is what's going to help them achieve their margin. So it's very important to listen to those nuances or read about them online or in the newspaper to see how management teams are managing increasing input costs and what that means for the consumer. That can give you a little bit of insight in terms of what these expenditures will look like for you. So even though we're making these observations anecdotally, they really are important to be aware of to guide you when you think about debt management and what's coming in and out of the household purse.
Right. Okay, let me summarize by just saying you guys were tremendous tonight. I'm sure our audience appreciates what you imparted to them. They will learn something, they will grow, they will follow this series. But more readily available is check in with Jill Malandrino and her trade talks. Log into that, be a follower of that, as I do. I mean, and I find it very interesting because especially when you're working from home, I get a pop-up on my phone saying she's on right now. So I stop for 10 minutes. I learned something new. When that, when I don't know if you ever see me in there, Jill, or not, but I'm there. I'm there for you. I'm supporting you. Christina, again, thank you. I don't know how to what my debt looks like to you right now, and my debt management, I'll work on that. But I appreciate all that you have to offer, the fact that you're nice enough to come out. And by the way, let me just back up to Jill. I also know you weren't feeling well. This also reflects upon your dedication to this program as well. But back to Christina, I just once again thank you for your knowledge and what you're sharing with us and how you guys are all doing what you're doing. And Heather, I didn't know what the Fed was going to offer tonight, what you're going to offer tonight. But I'm so pleased. I mean, I'm glad to see that you're not the prototypical federal government worker that only can say certain things and act certain ways. It was nice to hear exactly what you were thinking and how you felt about certain issues. That added to our knowledge base as well. Marvin, you know what I feel about you? I love you, my brother, and hang in there. So everyone, if you do get a chance, please go back to last Thursday's program, Investing 101 or 101 Investments, and you'll find that on YouTube. And you'll also agree that you'll see quite readily that we talked a little more about investing and savings and things of that nature that might help you here during April Financial Literacy Month. And I have nothing more to say. I'm just going to let this thing go for now. Thanking all the sponsors again. Thanking my brothers and sisters with the National Black MBAs for putting up with my madness. And once again, I'm sure we'll have another session again sometime relatively soon. Your feedback to us tells us what we need to be sharing with you. So please write in, let us know what your thoughts are, whether you like the program or not, and we can move forward from that. Unless anybody has anything else to say, I'm gonna say thank you very much. We're about 2 minutes to the good, but that you use that right now to start taking your notes, logging into Trade Talks, finding Christina's LinkedIn and joining with her. And he goes, Heather, you're not going to worry about these people. Maybe when you're teaching a class, they can all come join you. Thank you so much, everyone, and have a good evening.
Thank you.
Thank you.
Thank you, guys. Have a good night. Bye. Bye-bye.
Yeah, thanks so much.
Thank you.